the portfolio analysis of two Malaysian energy companies, Bumi Armada and Hepscas Petroleum. The analysis is strictly based on established data and methods, focusing on risk return, characteristic, and optimal allocation strategy to provide clear reference for investment decisions. So that's our group member, and that's our contents. So we can go to the first part.
Part one, introduction and methodology. Our core analysis targets are the two aforementioned Malaysian energy companies whose business sensitivities to market change differ significantly. Bumi Armada as an offshore energy service provider. Its business performance largely depends on the length of contract terms and equipment utilization rate. Hibiscus Petroleum. It is an independent upstream enterprise engaged in oil and gas exploration and production, and its performance is more susceptible to fluctuations in oil and gas prices. Research methods. Return calculation. We first calculate monthly long returns and then convert them into annual data using the following formulas. Annualized return equal EXP multiply 12 monthly mean -1. Annualized volatility equal monthly standard deviation multiply the square root of 12. Capital asset pricing model CAPM analysis. We estimate the CAPM bit coefficient using the heteroscedasticity and autocorrelation consistent Hack robot inference method and calculate the expected return with the help of the security market line (SML). In the calculation process, the risk-free rate is set at 3.59% and the market return rate is set at 9.19%. It is worth noting that although the portfolio composed of these two assets can reduce risks to a certain extent, the risk reduction effect is limited because the correlation between the two companies reaches 0.624, moderately high. Therefore, we recommend centering the investment strategy on the minimum variance portfolio MVP. Okay, next page.
Hello everyone, my name is Chen Xiuyu. Today I want to share the second part of our analysis, independent risk analysis. Okay. Simply we are looking at the risk of three assets based on their monthly ratings. The three are the market portfolio Bumi and Hibiscus. Our data covers 50 months. Let's start with listing. The marked portfolio minus 0.30% per month, about minus 3.55% per year. Boom, minus 1.11% per month, about minus 12.47% per year. Cibicus, 0.57% per month, about 7.02% per year. So Cibicus looks the best. The only one with positive ratings. Sounds greater rate, but ratings are only half the story. The other half is risk. Not the risk. The market portfolio is the safest. Its volatility is just 0.0306. Even annualized, still very low. This shows one thing clearly: diversification works. Boom is the worst. Bad ratings and the highest volatility 0.2340. Cibicus, yes, it has productive ratings, but its volatility is 0.1717. That's more than 5 times the market portfolio. So two key lessons. The market portfolio is safest because it spreads risk. Boom. High risk price ratings, not a good solo choice. Cibicus can bring gains, but risk is huge. If you invest, you need strict risk control to ramp up chasing. Ratings is fine, but managing risk is even more important, especially with assets like Cibicus big. Ups and downs mean you must stay careful. Okay, next.
Okay, let's go to part 3. Portfolio risk analysis script. Now let's analyze the risk and the return of two assets portfolio between Bumi Armada and Hibiscus Petroleum. First, their correlation coefficient is 0.624. This is a moderately high positive correlation, which means their prices tend to move together. This limits the potential diversification benefits. As the portfolio risk cannot be reduced as much as they were uncorrelated. The core of this analysis is to assess efficient frontier. This curve represents the set of optimal portfolio that offer the highest expected analyzed return for a given level of analyzed volatility or risk. On this graph, you will see two key anchor points. Anchor 1, Bumi Armada, with an analyzed return of negative 12.47% and a high analyzed volatility of 81.06%. Anchor 2, Hibiscus Petroleum, with a positive annualized return of 7.02% and a lower volatility of 59.49%. There are two critical portfolios on this frontier. The minimum variance portfolio, this is the leftmost point on the curve and represents the mix of these two assets that give us the lowest possible portfolio risk, measured by the standard deviation sigma. The no-short scale tendency portfolio. This is a portfolio on the efficient frontier that has the highest Sharpe ratio. The Sharpe ratio is calculated as portfolio return minus the risk-free rate divided by portfolio volatility mu p minus RF divided by sigma p. It measures exact return per unit of risk. As no short scale implies, we are only considering portfolio where we hold a positive amount of each stock. Thank you.
Hello everyone, this slide is optimal weight, MAP, and no short tendency. Next slide. Okay, the table below comprises two key portfolios. The first one is the minimum variance portfolio. Its weight Boomi is 12.9% and its hibiscus is 87.1%, and its annualized expected return is 4.27%, and annualized volatility is 58.91%. Its mostly sub is 0.0003. It's near zero, where it's very weak risk compensation. The second is tendency portfolio. Its weight Boomi is 0%. Its hibiscus is 100%. The no short constraint proposes the optimum to the boundary. The annualized expected return is 7.02%, and annualized volatility is 59.49%, and its mostly sub is 0.015. It's higher than MAP, but still low in absolute terms. And this is implementation strategy. The first is with credit management. Set 5% credit around MAP. Boomi's weight ranges from 7.9% to 17.9%. Adjust only when weights deviates beyond the credit to cut transaction costs. The second is low turnover rebalancing. Avoid high frequency adjustments for minor deviations. Rebalancing 50% of the gap back to the target to reduce unnecessary turnover. Okay, next part.
Dear everyone, I'm Zhang Lingjing. It's a pleasure to walk you through CAPM beta estimation and the security market line. Okay, next page. First, let's delve into CAPM beta estimation. From the data table, both assets, Boomi and Hibiscus, have betas greater than 1. Beta measure an asset's sensitivity to market movements relative to the average asset. A beta more than 1 means these assets are far more responsive to market changes, and Boomi with a higher beta is even more sensitive than Hibiscus. Now looking at for this responses, the excess return assess earnings beyond what CAPM directors for both Boomi and Hibiscus. Alpha's p-values are high. There's no solid evidence that their outperformance vs the market is anything more than luck. They aren't consistently beating market expectations. Okay, next page. Next up is the security market line, SMAR. From our tables, market risk premium is 9.19% minus 3.59% equals to 5.6%. Using this, we calculate Boomi's expected annual returns as 17.17%, Hibiscus as 16.09%, and the market's own expected annual return as 9.19%. A key point is SMML is the long-term pricing benchmark, not a precise predictor. When the risk premium shifts, assess returns adjust in sync, but the relative ranking of the assets expected returns stays the same. To warm up beta estimation lets us gauge assets systematic risk. And the SM will give a risk-based framework for pricing assets, helping us assess if an asset's expected return is justified. Thank you for attention. Okay, next.
Hello everyone, I'm Liu Qi. Let's into part 6, tail risk and conclusion and recommendations. Okay, next page. First, let's talk about tail risk. One question here, how bad is bad? We use a historical, non-prometric and approach, no disruption guys. Confidence is 95%, so we use two metrics, the VAR and the ES. About VAR, in 95% of months, loss does not exceed a threshold, and about ES, in the worst 5%, the average loss in that amount. So VAR sets the floor, ES captures severity, together they map the tail. Energy is volatile with heavy tails means can mislead. We keep the same window and the same 95% confidence with a non-parametric method. Results are auditable. This page gives the risk coordinate next we turn it into policy. Okay, next page. Conclusion and recommendation. Two calls. First, the rule equals 0.624. It means that depth fixing is limited. Second, tangency is mean driven and fragile. MVP is convenience driven and stadia. Because EI says the worst 5% average loss, we anchor on MVP and express this as plus minus 5% coverage with low turnover rebalancing. The rule 1 is weights, Boomi 12.9% and Hibiscus 97.1% MVP. The rule 2 is corridor plus minus 5% around MVP. For Boomi, that is 7.9% to 17.9%. And rule 3 is rebalancing. Low turnover for small drifts, revent 50% only. So about risk down, if a risk-free asset is allowed, use 100% Hibiscus plus bonds. Remember, lower risk, more bonds, higher risk, fairer bonds. About disclosure, report variance contributions with weights. Boomi's risk score will exceed its 12.9% weight for scenarios. Test O and plus minus 20% and correlation up to 0.8 in both narrow corridors at bounds rates threshold. Finally, VAR and EIs face the downside. MVP plus ruler study the path. Disclosure plus scenarios build a truth. Okay, that's all.
Okay, thank you listening, and thank you for our Dr. Rosalind Jaffa. We love you.